SpaceX stock Perps see 50 milers in liquidations as crypto leverage hits equities. A perpetual futures contract tracking. SpaceX, a company that has not completed its public listing, racked up roughly $50 million in liquidations over a 48-hour window, according to a June 25, 2026 report from CryptoSlate. During that stretch, the contract, traded under the SPCX ticker, ranked behind only Bitcoin and Ethereum in crypto liquidation volume. The number puts a private rocket builder in the same forced exit league as the two largest digital assets. It is one of the clearer signs yet that crypto's leverage machinery has wrapped itself around Wall Street equity exposure, and that the wrapper can break faster than the underlying stock ever moves. A pre-IPO company priced by perpetual futures SPCX is a cash-settled derivative, not a claim on actual SpaceX shares. Traders take leverage long or short positions against a price feed, settle in stablecoins, and never touch the equity. The contracts have appeared on Hyperliquid and on Binance as SPCX USDT, with pre-IPO perpetual futures also surfacing on Coinbase and Crypto.com. That structures the whole story. SpaceX stock opened near $150 on Nasdaq in June 2026 after an IPO price around $135, and during the volatility window, it traded below the open, testing the $150 line. At one point, Hyperliquid's SPCX contract implied a SpaceX valuation above $2 trillion, a figure set by margin traders rather than by an SEC filing or a primary share sale. When a derivative prices a company before the company prices itself, the derivative becomes the discovery venue. That is fine on calm days. It is expensive on volatile ones. $50 million liquidated in 48 hours liquidation figures carry some spread. CryptoSlate reported about $50 million over the two-day window, while an infographic referenced in the same piece cited $76 million. Either way, the contract sat second only to Bitcoin and Ether for forced closeouts during the period, which is a striking position for an instrument tied to a single unlisted company. Liquidations happen when a leveraged position loses enough margin that the exchange closes it automatically to cover the loan. Perpetual futures have no expiry, so positions ride funding payments indefinitely, until either the trader exits or the engine exits for them. Stack high leverage onto a thin, newly listed reference price, and the closeouts cascade. Each forced sale pushes the mark, which trips the next position, which pushes the mark again. The point is not that SpaceX is in trouble. The point is that the perp layer can manufacture a liquidation event independent of the equity's actual journey. Leverage layered on top of leverage. There are three distinct layers here, and conflating them is where traders get hurt. The bottom layer is SpaceX equity itself, traded in regulated markets with circuit breakers and settlement windows. The middle layer is the SPCX perpetual, a margin product that trades continuously and reprices every second. The top layer is the crypto liquidation infrastructure that force closes positions during stress. Each layer adds leverage and removes a break. Traditional equity markets pause. Perps do not. Equity price discovery happens in auctions and during set hours. A perp marks 24/7. So a contract built to give crypto traders SpaceX exposure can trigger margin calls faster than the underlying share price could ever produce them. The amplification is structural, not a glitch. These are also cash-settled wrappers on venues that hold the collateral. A trader carries counterparty risk to the exchange on top of price risk. The same insolvency exposure that has burned custodial users before. Self-settled positions in your own wallet do not erase market risk, but they remove that second failure point. Tokenized equities meet a 24/7 liquidation engine. The SPCX episode lands inside a broader push to put traditional assets on crypto rails. Fund managers have moved tokenized bond and money market products on-chain, and exchanges have raced to list equity perps, pre-IPO contracts, and event futures alongside spot tokens. The pitch is access, round-the-clock exposure to names that retail traders cannot easily reach. The cost is the one SPCX just demonstrated. A 24/7 leverage venue does not only widen access, it widens the path to a forced exit. Tokenization brings the asset closer. Perpetual leverage brings the liquidation closer too. For anyone trading these products, the practical read is narrow. Treat a pre-IPO perp as a leverage bet on a thin reference price, not as ownership of the company. Size positions for the funding rate and the liquidation level, not for the headline valuation. And keep the venue's solvency in the risk calculation, because the collateral sits with the exchange until the position closes.